boomers were about 4 times the wealth at this age that millennials are.
Hi, everyone. Welcome to Housing Insiders, the podcast for founders, builders, lenders, regulators, and all of us who believe that everyone should be well housed. I'm Jonathan Lawless.
And I'm Jeremy Potter. On Housing Insiders, we're here to pull back the curtain. I want to know what's really going on in the housing space, and we want to share it with you. So we talk to those in the know, and we're going to discuss actionable ideas that you don't hear anywhere else.
Before we bring in our amazing guest, let's catch up on some of the major headlines and things that are going on in housing today. And I want to start with probably the biggest one, which is the implementation of the NAR settlement, which is targeted to be effective on August 17th. Jeremy, give us your quick take on what that means for the industry.
The takeaway here, John, is that people aren't going to want to change, and they're not going to change. They're going to try to keep customs and practices that they're used to for as long as possible. So even though the NAR settlement says you cannot directly put seller-paid compensation into a listing or into the MLS, you're still allowed to negotiate it directly with the seller and directly with the seller's agent. So for most markets, for almost everyone, it's going to be a long curve to change because that negotiation is just still going to happen at the agent-to-agent level, at the individual listing level.
I think you're right. I think a million realtors are a strong reason why it's unlikely to change significantly. I think the consensus has been a small compression in what the commissions are. I don't know. If I were a betting man, I would say nothing's going to change, like you said. So, all right, let's move on to another fun headline here, which comes from the Redfin CEO, Glenn Kelman, who recently said on an earnings call that if mortgage rates don't fall, we will drink our own urine. So what do you take of that?
Well, the imagery aside, John, I think the question I have always asked, and the thing I'd always wondered was, if necessity is the mother of invention, where's the invention? And Redfin's been working on this problem for 15 years. And Glenn is as familiar with this cyclical nature of the industry, with a lot of the obstacles and barriers of change in the industry as anyone. So if he's saying this, it almost sounds like he's reached the end of his rope with how much he thinks will change or can change in this business. What do you think?
Well, I agree. I mean, I think rates go up, business slows down, we have to start drinking our own urine. If rates go up further, I suppose we'll turn to cannibalism or something along those lines. But anyway, final headline or final thing that's going on in the industry that I wanted to get your quick take on, Jeremy. I'll give a quick background on this. So if you have a government loan, an FHA or VA or rural housing loan, that loan can be assumed by another person. In other words, you can give them your mortgage if they're buying your house. Now, you can't put it on another house. That would be called portability. Assumability just means somebody can take your loan when they buy your home. Now, for the last 30, 40 years, that didn't really matter because rates were continuing to go down. But now that rates are going up, if you're selling a home and you have a 4% mortgage today, the person who's buying your home would love to take your 4% mortgage instead of having to get their own 7% mortgage or 6.5%, wherever rates are. So clearly this is a really big opportunity. There's a lot of outstanding FHA and VA loans. So there's, this really interesting moment in which people can basically hand over their mortgage to new buyers. What are you seeing in this trend? Is this something that is going to take off, or?
Well,
I don't know.
It sounds great, right? I mean, the way you just described it, I can buy a house and I can get the interest rate that exists on that house without having to reset to a market rate. At first glance, it's absolutely fascinating. It's interesting, and buyers and sellers are going to be looking at it as an opportunity. There's one really big catch. The really big catch is the seller typically has equity in the home. And so when you assume that mortgage, it's not that the equity gets assumed or gets passed without being accounted for. And the best way, the only way to account for that equity right now is cash. So your down payment on an assumption ends up being the entire equity for the seller. And those buyers find out that 4% sounds pretty good. Paying out 30% equity in the home, should the seller have that much, or even 15%, is a pretty dramatic down payment when the typical FHA loan that you're assuming has a 3.5% down payment. So it's really about cash up front for whether or not this is viable for the buyer and the seller, and finding the perfect buyer who has the exact right amount of cash to offset your equity can be very difficult.
Well, and given that millennials have been sitting on the sidelines and hoarding their cash and waiting for an opportunity to buy or waiting for rates to come down, my guess is there's a lot of affluent buyers that have a lot of cash that could take advantage of this situation. An interesting company that I've been looking at closely is a company called Roam, ROAM, who's been aggregating this data and making it easier for people to take on and assume mortgages and even maybe find second liens to cover some of that additional equity if they don't have the full cash. But I think there are a lot of people that could do this if they know about it. So for me, it's a trend definitely worth watching.
Yeah, agreed. I think that that idea that this company is going to help you find each other, it's really a matchmaking service. And then this question that we'll probably talk about a lot on Housing Insiders is second liens, additional investors, other ways to lower the cost of entry into the home. That's a theme that's going to come up a lot for sure.
Yeah, agreed. Okay, turning away from the headlines, it's time to introduce our guest. Chrissi Johnson is the founder and CEO of Alinement Initiatives, which is a nonprofit accelerator doing amazing things. They're committed to realigning basically the trajectory of housing through things like new ideas, collaborative partnerships, really incredible stuff. She's now also the VP of External Affairs at Prosperity Now, and she is definitely someone who shares our belief that it's time for less talk and more action when it comes to things like boosting the supply of housing, new innovation, more affordable housing, more equity.
John, you and I and Chrissi were all together in Brooklyn for the Realignment Conference recently. So I'm excited to dive in and share everything we can and everything that we've done with Chrissi with our Housing Insiders audience. So thanks, Chrissi. It's so good to see you.
Good to see you. I miss you. It's been 2 weeks.
That's
Feels
right.
So long.
Too long.
Let's start with the conference because it did turn out to be a really amazing event. And so just give us a little bit of the backstory about the event. You use the word salons alike a lot when you've done things like appraisal bias and QM things. So give us a sense of like what that means to you and why it's important.
So I came up with the salons because I've been in the government. I've been in corporate America. I've sat around a conference table around a platter of stale Danishes where we all like pat each other on the backs and then go get excited in the moment and then say we're going to do something and then simply don't. And then we revisit it again next year. We need to rethink how we're doing things. And if we bring together all these different perspectives with the goal of actually committing to action and not just pontificating without purpose, that goal is actually going to change and the actual groundwork that we're in to create a seismic shift that will open things up to create new space for new innovation. And so we came up with Realignment a couple years ago. We came up with it because we need to realign the way we think, the way things work. And the only way to do that is to get the people at the table who are the leaders, existing leaders for sure. There need to be decision makers at the table. We also need the people there who are going to challenge their conventional wisdom, challenge the way they think in a way that they listen. So everyone there is handpicked. We choose, like I said, decision makers, but we also bring in the innovators, the startups who may not be a part of the official system yet, but they are coming up with the ideas to expand that system in a responsible way. And then we create space for everyone to talk with each other. And from that, we don't stop. There's a commitment. We ask for commitments. So how do we move forward? How do we stay engaged for the rest of the year? How do we drive progress? I am really proud of what we did. And both of you were essential parts of making it happen. In fact, you both are saloniers yourselves. And I'm glad that you both wear the, I guess in this case, glasses proudly instead of the hat. But I think you actually can speak very well to the success of it and what it takes to drive a successful modern day 2024 salon and housing.
So I want to pivot a little bit. One term that we use, Chrissi, and I'd love to get your thoughts on what it means to you. But we were using the term the housing industrial complex. I think maybe we've even used the term already early on in Housing Insiders, but just to sort of think about the way that the industry in housing is so entrenched, so big and hard to change. When I say the housing industrial complex, Chrissi, who does that make you think about? Like what are the entities that you think constitute sort of this complex, if you will?
The housing industrial complex, when you talk about it, to me, sounds like the existing structures like the GSEs, the traditional lenders, including banks and non-bank lenders, all of the folks, companies, organizations who are part of the system as it exists today.
So when I sort of think about the housing industrial complex, it's like I'm sitting on one side of the fence and I've got an idea on how to change the system. And there's somebody on the other side that I've got to convince. And the person on the other side has a completely different set of perspectives on the issue. And I think we heard loud and clear, and Chrissi, I'm glad you said it up front, like, this is not meant to say like, oh, look at these big companies, they never change. I think that's just sort of a naive view that we could have said for the last 200 years. These are big companies that are responsible for trillions of dollars. They're responsible for millions of people's livelihood. And if they fuck up, like, it's not, oops, I messed up, I'm going to go start my next company. It's, oops, I destroyed the American economy. And so on their side, they've got to be a lot more careful, a lot more thoughtful. And that's why they want to take 3 to 5 years before they really introduce major change. But that misalignment is sort of what I think about the industrial complex. It's the group of people who are responsible for the underlying structure of the system that can't make fast change, but in a lot of ways are expected to make fast change by the people who are innovating.
Almost sounds like compound.
Yeah, compound. Okay, it's not like somebody's got guns. If it's a compound, I don't know.
That's
they definitely don't have guns.
It feels like, well, what I'm hearing you say too is that it's not that they're not open to change, but it's been hard for them to let anyone in, right? Because of the complexity of the compound. Even if one lender wanted to try something, it would depend on one of the GSEs accepting that as under their guidelines, and or SIFMA. I mean, it can go on and on. So the complexity of it is spot on. I do think, though, there's when you talk about a complex, that there is an opportunity to, I think of a channel like a water, different waterways. Usually you can find a way in. And that's where I want to lean into. Like I said, it could be more forgiving than what we're getting to here. And I would love to lean into the definition of that term to be, I guess, more Pollyanna and be like, we can do it. We can get in. Let's find one of those waterways to get into the complex and make it less of a compound situation.
I mean, that is the question we hear the most. The question we hear the most from companies, startups, and innovators is, how do I get in? How do I put this in front of someone? I have an idea. I want to do something. And I think the thing I've realized is we get an equal amount of questions from inside the compound that is, you know what should happen? You know what somebody should do? The people inside want to do the right thing, want to do positive change for homeowners. And I will say, as far as I can tell, most customers, most renters, most people shopping, most homeowners actually expect change. They don't expect things to stay the same. They've been conditioned to expect change, and yet we can't get these ideas to succeed. Yet it doesn't happen inside the compound. And then we have a group of innovators and startups asking us, how do we get this in front of you? We have all of this potential, all kind of staring at each other. And what we're trying to do is say, what's keeping them from interacting? What's keeping them from making change happen? And certainly, we mentioned that the risk and the fear, especially at, the federal level, the GSE level, is real. And certainly the global financial crisis looms over why the GSEs are in the position they're in.
And I would argue it's not that I agree with you that they do expect change, but it's interesting. The industrial complex compound has not adapted to the way things are actually, because this isn't new. I'll use like shared ownership as an example. Culturally, especially for Black and Hispanic communities, this is something that they have been comfortable with and been doing for generations. And yet the system hasn't acknowledged that that is a desire that these communities have. Why don't we listen to the current consumer who is no longer majority white? We are diverse. We come from different backgrounds. We come from immigrant families. We come from urban areas. We come from rural areas. We have different definitions of family, and we have different definitions of home. That is the modern consumer. So how are we as a complex compound going to look at that and adapt accordingly?
You guys both sound way more fucking optimistic than I am about this. Let me just make the reason I call it the housing industrial compound is because Jeremy, I don't think people expect it to be different. I think if you ask the average consumer who buys a home maybe 1 to 3 times in their life, do you think your mortgage is going to look any different than your great grandfather's? And my guess is they'll say, I don't know, probably not. Like people just don't. And part of what I think the issue is when things don't change for a long time, they metastasize and they start becoming parts of the internal systems and they are impossible to remove. And so just an example, FICO score. I mean, the mortgage industry has been using the same FICO score for something like 20 years. FICO has been around since the late 90s. There's not much that has changed in terms of credit scores and credit bureaus. I mean, if you look at every aspect, you've got these sort of very long-term, very unchanging, existing entrenched interests that have just, because maybe of the global financial crisis with the GSEs, it's been so hard to change them. But in the meantime, they're sort of putting their tentacles into every part of the system and becoming even more difficult to remove. So I agree that there is a sort of like expectation, certainly around people that are innovative, like why can't we change? But people buy a home very infrequently. Like I use my phone a lot. I expect next year my phone to be better. I think people have that expectation, but people don't interact with the housing industry. I think they expect it to be the same. And that expectation is just, we are making that a hardened expectation. And unless something dramatic happens, and I want to get into like what dramatic can happen or how can change happen or how can those waterways get created, consider me a little less optimistic.
I think what I'm referring to is asking the right question. And so if you ask somebody about a mortgage specifically, I think, yeah, they're going to say 30-year fixed, right? What else do I need to know? But when you ask the next question, which is, what did you struggle with or what are you struggling with right now? I have no idea how much my home is worth. I wish I could split it, to Chrissy's point. I wish I could split it with other people. I have other people who want to help me out. Once you start asking the right question, what you find is the customer expectation, thanks to the phone and thanks to having a lot of data and dashboards right in your life for all kinds of other things, you end up start expecting that. And we've not delivered on that. The industry's not delivered on, I know how much my asset's worth. I know what I'm allowed to do. I know what I'm not allowed to do. I know who's allowed to be involved and not allowed to be involved. You're on your own. And one of the things that this industry in particular, this moment in the industry, when we are struggling with data and FICO scores and access, the message I'm hearing coming from the industry is, well, work harder and wait longer. Work harder, wait longer. And that's what most young people are hearing about how to get into housing. So if we do stick with the same old infrastructure, we're actually going to have a lot of disillusioned people on our hands.
We're gonna?
We do. We're just, the disillusioned generation is here.
We are here. What am I, a geriatric millennial? Is that what we're called now?
Elder millennial. We are elder millennials. Thank you.
Gen X, baby. I'm a whole different generation. I see things way more clearly. Joking. All right.
Are you not disillusioned?
Before we pivot to some ideas on how we fix this thing and where we've seen hope and where we think there could be hope in the future, let's pause to hear a word from our sponsor. Are you a points junkie or a member of a rewards program? Well, if you are, then you're going to love what Bilt Rewards is doing. Bilt Rewards is just like an airline program, but this time it's centered around your home. Instead of earning points or miles for flying, with Bilt Rewards, you pay your rent no matter how you pay, and you can earn points. And those points are now the most valuable reward currency in the industry. You can use it on everything from travel, Amazon, and importantly, you can use it towards the down payment of a home. So now, imagine a world where every type of housing payment, be it rent, condo fees, mortgage payments, allow you to earn rewards and access a huge number of other benefits. Imagine then, as a housing provider, being able to use points to incentivize good behaviors like paying on time. Bilt is absolutely going to revolutionize the housing industry. If you want to learn more, please email me at lawless@biltrewards.com.
Chrissi, you've had experience bringing solutions that actually changed policy, that made a difference to the companies and the people that we're talking about. Can you talk a little bit about how we solve for this and what you've been able to do?
Let's just say hypothetically that you bring everyone to the table and you are responsible for your own actions. So with that in mind, how do you listen to make better decisions for yourself so that you can change the situation moving forward, how you can change your actions to better interact with the other side of the table. So if you are a lender, let's say a general, not even a lender, a practitioner, and you know that your product is going to serve consumers but may have certain risks, is it a better idea to bulldoze forward and be like, okay, no, you know what? If we get sued or if we get an enforcement action or if we harm people, God forbid, who cares? At least we tried. Or is it better to be measured and be like, hey, advocate, hey, regulator, hey, consumer, hey, innovator? What is a better path? I have this idea. I have this pathway. Do you have recommendations for improving to better expand access to home ownership for people who are mortgage ready, mortgage eligible, or maybe not mortgage, home ownership eligible? Let's just call it beyond the mortgage. So we're talking about getting about the outside of the complex compound, home ownership eligible, not just mortgage eligible. What does that look like? And so we saw that with QM. We're starting to see that a little bit with appraisals. It's taking longer than we had hoped for. But QM is a prime example where the patch was going to expire. We could have either kicked the can down the road and extended the patch, or we could have done what actually happened was advocates coming together with the lenders and saying, we agree, we want to make this better, so let's come up with a solution. That solution, just for like history and awareness, that solution became the law to the new QM rule that exists today. That went into action during the Trump administration and is, I think, the only CFPB law, don't quote me on that, but I'm pretty sure it's the only CFPB law from the Trump administration that stayed, that wasn't turned back under the Biden administration. And that is because of the broad and diverse support that was the underpinning for that solution. The advocates, with the lenders, with everyone else, the innovators, everyone else coming together with a solution that was good for consumers and good for the market. And that's how we're going to actually understand each other, to figure out each other's situation, to find a path forward.
So, John, step one is consensus. And with policy and with lawmaking, Chrissi, you're exactly right. That is consensus. Step two is I want to now try something. I want to now try this. Can you talk a little bit, John, about piloting an idea, which in the VC world, in the startup world, is how you get started, right? Some of what you talked about at the conference was, let's talk about the lifespan of a startup. We got seed round, you got to prove some things. And what we're talking about here is let's try some things. The only place to try something is the GSEs, right? We've just identified that. They've sucked all the oxygen out of the market for the most part, not all of it, but almost all of it. And so that's what step two is. Let's try this. What's the outlook on that? How do you try something in this market when the lifespan of a startup is potentially a year or two?
You're right. You get consensus, you get the right people in the room. The next thing that's got to happen is action. We talk a lot about taking action. What do you do to take action? And unfortunately, the pilot thing just drives me fucking crazy because it's just a way that we take action that feels like a form of kicking the can. And the reason I say that, again, is this misalignment of timing. I want to pilot something as a startup because I need to go prove something that's going to get me broader market adoption, and I need that change to happen in 1 or 2 years. On the flip side, it's like, well, I'm going to approve your pilot after a year-long process, especially if it's the GSEs who have to get public input and opinion. Then it's going to take me time to implement, and then nobody's going to say it's working or not unless you've got a couple of years to study mortgage outcomes, right? Because it takes 60 days for somebody to find a house, get a loan, get into the house, and then you've got to watch to see whether or not that loan performs over time to see if what you're doing actually has the long-term outcome that you want. That's just too long, and so I would really sort of stress that I think the way we think about pilots just kind of needs to fundamentally change, because I don't think pilot is an action that I have seen that successfully bring about broader change. There's a whole graveyard of unsuccessful pilots, many of which I've been responsible for, that I just now kind of look at and say, maybe the pilot isn't the action that we're really looking for.
I agree with you that there's a graveyard of pilots, and that pilots as they currently stand may not be the answer. But I think conceptually pilots could be. And I think about this in a way where, we talked about what led to the crisis was a bunch of not pilots disrupting the market. Is there a place where if we reassess pilots and actually get the powers that be to commit to real action with pilots, that could be a safe path forward? Are you just anti-pilot? Down?
Well, for fear of the airline industry not liking me, I'm not anti-pilot, but I think you just have to be very realistic of what a pilot means. I think too much the idea of pilot is a comfortable, safe, non-intrusive place to start. And it's too comfortable and not thinking so much as this is going to be dipping our toe, but we're diving in this water really quickly if it's working. And I don't think that's the attitude. Plus the other thing too, and I'll give a very good example. Freddie Mac just announced that they asked for permission to do second liens. They decided they're going to pilot second liens. Okay, second liens is a financial product that requires liquidity and capital markets to be successful. So if Freddie Mac steps in, yes, they're going to make second lien rates better because now it has a quasi-government insurance. But at a small volume, it has zero liquidity. And that zero liquidity means the rates are going to be higher. So you're going to pilot something whose very success relies on volume and liquidity. It just feels like it's just misusing pilot. It's just an excuse. Yeah. We're not going to dive in because we're worried about the long-term impacts of having a broad liquid second lien market. So we're going to do a pilot, but honestly, that pilot's going to take 5 years. And after 5 years, it's going to be like, well, there's no liquidity in this product, so the rates are too high and nobody wants it. It's like, well, no shit. That's the problem we're trying to solve for. And a pilot was the exact wrong way to solve for that. Now, don't get me wrong. I'm very grateful that they're able to go out and do something because doing something is better than doing nothing. But we just have to put our mindset in the right place around what it is that we're doing and what outcome we expect, and then how quickly we're going to move to doing it all.
That's right.
What would a lawless pilot look like?
I think you answered your question. I think this is a fundamental challenge and we need to find another way around it because you can't pilot a product over 5 years and expect it to work. You got to dive in head first and get it out there and deliver at scale. And so, I would love to find another waterway, to your point, Chrissi, that sort of works around the existing system, or alternatively, get the existing system comfortable with taking more significant risks than a few $1 million here and there on some random pilots. Let's really give some space for something to succeed and take off.
I think one of the biggest assets we have is data, and it's getting better and better in a lot of different areas. And so I think we're misusing our best asset. In other words, to use John's example of the Freddie Mac second liens, what was the data? What was the need? What did it say? What did the market tell us we needed to do there? And we're not good at data. I'll use rent payment history as an example. People have been paying rent forever. John, you've been working on rent payment history as a way to measure a proxy for housing payment for years. It took 20 years to get people to wake up and go, what's a pretty good comp for paying your mortgage, paying your rent every month? But we didn't have access to data in a reliable way that spoke to the risk we could share with investors about how this asset would perform, right? And so I think there is ways to accelerate pilots by using data sources and data analytics in a better way. I just think we're not used to it. And we have to do a better job getting that story in front of the right folks. And then asking them, for your point, John, to trust that there is going to be aspects of pilots we don't know. You can't know everything, and we're never going to know everything. And if we have a good business case, we should be able to do that.
Jeremy, I think you once said to me, and I 10,000 billion% agree with you, but when we were talking about this with appraisal modernization and the need for data, and why are so many practitioners in the appraisal space so opposed to data collection and doing it consistently, having that quality control, having that clarity, removing the subjectivity. I think you said the best time to start is yesterday. So why not start collecting now? Because in order to build toward the future, we need data begets data. And it's going to just by collecting it, it's going to improve the data and improve the data so we can have a better outcome in the end. So I'm just repeating what you said, but using a quote from the past that you've used that I think was very illustrative of what we're.
Yeah, I got to disagree a little bit on this, because I think data is another form of talk. I swear to you, I can give you any answer you want supported by data just by changing the way it is. Why do we need data on second liens? We have second liens have been around forever. I mean, we know what a second lien is. It's a pretty straightforward thing. I think a lot of times it's sort of like this analysis paralysis. Like, well, yeah, we used to have them, but it was a different environment, so we need to test it out on this environment. It's like, what the fuck are you talking about? I'll give you, like, rent reporting is another example. Okay, we have been talking about using rent reporting in mortgage underwriting for 20 years. And so the problem was like, well, nobody's collecting it. Okay, let's start collecting it. And so we go and collect it. It takes forever to get it into the bureaus. And finally, we're doing it at scale, thanks to places like where I work and the like. But now it's like, well, now we need to see mortgage performance now that we have the data. It just becomes this continual loop of excuses that don't really jump into it. So, Chrissi, if you want to ask me what the Lawless pilot would look like is, hey, look, if somebody's paid their rent on time for the last 24 months and their mortgage payment is within 10% of that, give them a fucking mortgage and let's see how it goes. Now, I know all the analytics people will come to me and say, no, we've tried to measure that. It doesn't seem to perform. It's like, but who cares? Like, all right, let's take a little more risk. The person has been paying their rent for 24 months without problem. Let's give them a shot to pay the same kind of mortgage and see what happens. Now, we'll get some delinquencies, we'll get some defaults, but we'll also get a lot of new homeowners and a lot of people that can afford to pay their home. And again, we'll learn a lot by trying to do that and find different subtleties, but until we actually stick our neck out, we're not going to get quote unquote data. And if we use data as an excuse, we're not going to do anything. I just see that time and time again.
I think we're saying the same thing.
Yeah.
I just think we're saying the same thing in different ways, which is, where do you insert the trust? Because what you're talking about is exactly a data-driven analysis. What's the story? The story is, we know this person can pay and we're willing to give them a shot. I think what we do is we tend to pick really low-hanging fruit and that isn't going to make a tremendous difference. And then we use that as the excuse to not go any further. I think that's exactly what you're saying. And that's exactly what's happened. It's like, well, we tried it with, to your point, whatever. We tried it with second liens and it didn't make a difference, so we're not going to try it with shared appreciation or something like that. Or we're trying it in this one way, and so we can't give anybody else a chance. I think what we're saying is, why don't you just actually use the word pilot for what it's meant for? You have a thesis. We have a thesis that's baked on, or built on, I should say, a data story. Now let's go prove it or not and build the market around that. I think that that's exactly what private capital should be doing. I get frustrated because we're talking about trying to do it through the GSEs, which is not the optimal way to do it. But because we can't rely on anybody else to try anything, we can't rely on anybody else to put up some of that risk in a meaningful way at scale for the country. We're just back to, maybe we can shove it through the GSEs because nobody else is listening if they don't do it, or they don't try it, or they don't have an integration for it. So I think we've painted ourselves into a really terrible corner from an innovation perspective, because private capital is just like, I don't have to do anything. I'm not gonna. And there's no reliability for anybody, lenders or otherwise, to rely on that solution. And so we just keep forcing it back through the only path that currently exists, which is a Fannie Freddie pilot.
And they're making money doing it. There's really not a whole lot of motivation.
Well,
besides doing the right thing. But
that's
I mean,
the metastasizing that John talked about.
Right. They know we need widgets. They're the widget machine, and they know exactly the pathways and the molds to make the widgets. So, I
mean, they see themselves again as the protector of the American economy, and changing the way widgets get made can be super detrimental. But we're supposed to be thinking about solutions, and this isn't super practical, but I mean, the reason private capital is really good at this is competition, right? The VC market is hyper competitive. You can't build a company that works really well. I'm going to take my lunch bags, go home, and find somebody else that can. And that continual rebirth and retrying, super competitive, and leads to great innovation. The GSEs are supposedly going to be privatized. But name one private company that hasn't innovated for 20 years, or honestly tells itself it's not allowed to without a slow, careful process. So, one of the things I would say is, like, we need competition. The GSEs maybe should be forced to compete more with one another, have more consequences if you don't keep up with the others, allow other people to compete with them. But certainly, I think whatever the administration decides to do, the current or future or any administration, I think they really need to take a look at, is innovation core to the success of a company that we think should be privatized or is ultimately supposed to function like a private market participant? And if that is core, then we need to release the shackles a little bit for these. And not to pick on the GSEs, but I would say that across the board, you look at all these other sort of heavily entrenched interests and processes, and the fundamental challenge is they print money because their position allows them to, and there's zero competition. So we've got to find a way to elevate competition in all these markets and allow new entrants to put these companies at risk.
Here's exactly what I would say, John. You used the word earlier that if things get more desperate, we're going to cannibalize the market. Here's what I would say. The protectors of the American economy, as you just put it, are not defining the American economy broadly enough. If you fast forward what we're doing today, in 20 years, we will have cannibalized the American economy because we won't have given this opportunity for generational wealth and this opportunity for asset stability in communities that Chrissi mentioned earlier. So if we're truly trying to protect the American economy, we got to click out a couple of settings on the aperture and go, hold on a second. This thing has to last for generations to come. And we need communities stable and thriving for generations to come. And what we're doing right now might protect a certain risk bucket as we define it today, but we're actually doing it, I think, at the expense of the future economy for our communities and each other.
Heightening inequality, civil strife. As housing costs and housing payments go up, it's less money to spend on other things in the economy. People aren't building wealth. I mean, I think, Jeremy, your point's such a great one that if we keep thinking about housing as just this sort of little myopic industry that needs to be kept safe, and we miss the point that it affects everything else, and keeping it the same hurts everything else in ways that I don't think we have even really seen the full extent of the pain that a bad housing industry could cause. I think that perspective is one that hopefully policymakers can start adopting. I think it's a great call.
There's an argument out there that I've heard where people trying to steer away from housing as the number one asset building mechanism in the nation. And it's cute, but at the end of the day, you think about the Maslow's hierarchy of needs. What is the base one that we will always need? Shelter. Everything else
shelter
builds on top of that. And so, yes, there will be other ways to build assets in the nation, but the one that we can guarantee every single person will always need is shelter. And so what is a better way to build an asset than investing in something that we also need? You look at the way that millennials and Gen Z are building wealth compared to other generations before. I think it is like that boomers were about 4 times the wealth at this age that millennials are. People in these current generations are not able to build that wealth to pass on pass on the bundle of privileges that comes with home ownership. And you talked about other things that come with it, but we're also talking about like public safety, education, healthcare, where you buy your groceries, your ability to buy food, healthy food, all comes down to where you live. And that is a form of wealth and privilege as well. And if we can't figure out how to pass down that community benefit to generations to come, we're screwed.
Let me thank you so much for joining us and for having this great conversation with us. It has been enlightening, and I'm glad that there's fellow thinkers out there like yourself that care deeply about this industry and want to see it change and want to get better. That really is what this podcast is supposed to be about, is for us to give people an inside look at what's really happening in housing, but also to give people the opportunity to drive real change in this industry, which we desperately need. So that does it for this episode. For our listeners, we'd love to hear from you. Feel free to send us an email at podcast@thehousinginsiders.com. And of course, we ask you to subscribe and follow our podcast in your feed. It helps us grow this community. And again, thank you for listening.